Another day, another story. Assets allocation is an investment strategy that involves dividing an investment portfolio among different asset categories. The goal of assets allocation is to minimize risk and maximize returns by diversifying your investments. We'll be discussing what assets allocation are, their benefits, and how to create an assets allocation strategy that works better. Assets allocation is the process of dividing your investment portfolio into different asset categories such as stocks, bonds, real estate, and cash. Each asset class has different levels of risk and return potential. By diversifying your investments across different asset classes, you can reduce your overall risk and increase your potential returns. By diversifying your investments, you can reduce your exposure to any one particular asset class or investment. It can help to protect your portfolio from market fluctuations and economic downturns. Moreover, it can help you to achieve your financial goals by providing a steady stream of income and capital growth. There are few key factors to consider so that you can create an asset allocation strategy that works perfect. First, you'll need to assess your risk tolerance. How much risk are you willing to take on? If you're a conservative investor, you may want to allocate more of your portfolio to bonds or cash, which are generally less risky than stocks. If you're a more aggressive investor, you may want to allocate more of your portfolio to stocks or real estate, which have higher potential returns but also higher levels of risk associated to them. Another important factor to consider is your investment time horizon. If you're investing for the long term, you may be able to take on more risk in your portfolio since you'll have more time to ride out market fluctuations. If you're investing for the short term, you may want to allocate more of your portfolio to cash or bonds, which are generally more stable. Finally, you'll want to consider the fees and expenses associated with different asset classes. Some investments, like mutual funds, have higher fees than others, like ETFs. By choosing investments with lower fees, you can potentially increase your overall returns. Assets allocation is a powerful investment strategy that can help you to minimize risk and maximize returns. Once you've established your initial assets allocation, it's important to periodically rebalance your portfolio. Rebalancing involves adjusting your portfolio to ensure that it stays in line with your desired assets allocation. This may involve selling some investments and buying others to maintain the appropriate mix of asset classes. It helps you to stay on track towards your investment goals with least risk involved. It is also important to diversify within each asset class. If you're investing in stocks, you may want to invest in a variety of different companies and industries to minimize your risk. By diversifying within each asset class, you can further reduce your overall risk and increase potential returns. It's very important to consider the tax implications of your asset allocation strategy. Different types of investments have different tax treatments, and you may want to consider holding certain types of investments in tax-advantaged accounts like IRAs or 401ks. By managing your investments with tax considerations in mind, you can potentially increase your after-tax returns. If you're unsure about how to create an asset allocation strategy that's right for you, consider seeking the advice of a financial professional. He can help you to assess your risk tolerance, set realistic investment goals, and create a portfolio that aligns with your needs. Remember, don't put all your eggs in one basket. Assets allocation is all about spreading your investments across different asset classes to reduce risk. Assets allocation requires discipline and patience. It's important to stay committed to your investment strategy, even when market conditions change. Avoid the temptation to make knee-jerk reactions to market fluctuations, and instead stay focused on your long-term investment goals. Monitor and adjust through periodical reviews of your assets allocation strategy and make adjustments as and when required. This may involve rebalancing your portfolio, adjusting your risk level, or making changes to your investment mix. By monitoring your investments and making adjustments as needed, you can ensure that your portfolio stays aligned with your goals. Diversifying your investments across different asset classes, you can create a portfolio that works for you and your financial goals. Remember to consider your risk tolerance, investment time horizon, fees and expenses when creating your assets allocation strategy. Thanks for watching.